Hey guys, welcome to the show. Today's workshop I'm really excited about. It's not a topic I get to teach very often because it's a little bit more advanced, but it's fun nonetheless. And the topic is how to make big bucks with small accounts. And the reason for this workshop specifically is I always get questions like this. Nate, I've only got $5,000 in a Roth IRA. What can I do with that? Or I've only got $10,000 in an HSA. What can I do with that? I can't buy real estate with that, can I? Hold that thought because we're going to show you actual case studies from self-directed IRA investors that involve taking small amounts of money and turning them larger by the use of leverage. This is also real impactful for those of you who are looking at the other types of accounts that we have here at Nuview. And that's things like your health savings accounts, your education savings accounts for your kids, because these aren't very common accounts. They're not as common as your traditional and Roth IRAs. But they work magic if you can find investments for it. But the contributions to the plans are relatively small. So what do you do with a small amount of money? And that's what this workshop is geared to do, help you maybe think of some creative investment strategies so that you can utilize smaller accounts through the use of leverage and turn them larger. So let's just jump right into it. So first, our disclaimer, just a reminder to anybody who's new out there. Nuview Trust Company is a self-directed IRA custodian. All that really means is that we administrate retirement accounts, no different than a Fidelity or Charles Schwab. The only difference is that we don't sell investments to our clients. So all the information here is for education purposes only. We always encourage you guys to consult with your legal professionals, investment advisors and whatnot before entering into any type of investment. But the true power in a self-directed IRA is that you get to pick the investment and you make all the investment decisions without Nuview selling you investments specifically. So what is a self-directed IRA? This is the product that we have here, but what really is a self-directed IRA? Let's define it for anybody that's new. Self-directed is just a marketing term. It's not a type of IRA. If you're talking about an IRA or an individual retirement account, all IRAs are governed by the same set of rules. All IRAs can do the same things. It just differs between the companies that administrate your IRAs as what you're allowed to hold. So don't get confused with self-directed. We have IRAs, the same IRAs you would have at Fidelity, Charles Schwab, Wells Fargo, yada, yada, yada. We just allow clients to hold what are called alternative assets within these IRAs because we don't sell investments to clients. So you have a broader spectrum of investments to choose from, but the self-directed term comes from the fact that you have to pick the investment. You have to find it, we'll hold it, we'll sign off on the investment, but you have to find it. So that's where the self in self-directed comes from. What are the benefits of self-direction? Real brief, obviously self-direction allows you to truly diversify your retirement portfolio. And what I mean by that is self-directed IRAs allow you to invest in alternative assets, things that are not tied to Wall Street, like stocks and bonds. With a self-directed IRA, you're allowed to hold things like real estate, investment property, land, commercial property, multifamily, investments into oil and gas interests, mineral rights, cryptocurrency, the list goes on and on. So the simple fact of self-direction is allows you to diversify into assets outside of the public or traditional assets. So that's benefit number one. Benefit number two is that IRAs in general give you great tax shelter. An IRA by definition is a tax-exempt trust. You put money in it through your contributions. You invest it by finding investments that are held within it. But the beauty part about those investments held within these IRAs or tax-exempt trusts is that all of the profit grows completely tax deferred or completely tax-free. There's no annual taxation that hits you in most cases like it does when you invest as an individual with your money. So our money as individuals will grow slow because we're taxpayers. IRAs, HSAs, ESAs, 401ks grow faster because there's no annual taxation on the investments. But ultimately, if you're going to invest, just invest in what you know best. And you'll see in the case studies today that one of the types of leverage that these clients used is the leverage of their experience. And this is very powerful when you talk about self-directed IRAs, is applying your knowledge as an investor to the assets held within your IRA. And if you do that on a consistent basis, you'll probably find that you make better returns in the long run than just investing in things that people tell you to invest in. So always, always, always invest in what you know best. And a self-directed IRA allows you to do that if you are an investment professional, real estate professional, realtor, The list goes on and on. So what are the types of plans that can be self-directed? Real brief, we've got 7 types of plans that can be self-directed, and you'll notice that the names are no different than IRAs other places. We have traditional IRAs and Roth IRAs that can be self-directed. The only difference between these plans is how they're taxed. One is pre-tax, which would be your traditional IRAs, and the beautiful Roth IRA is an after-tax IRA. You'll see in the case studies a lot of the investment strategies where you're going to take a small amount of money and make it larger. Ask yourself the question before you do that investment: do I want to pay taxes on the seed or the money tree that this is going to grow into? You'll see in each of these case studies, they were done with a Roth IRA. They could have also been done with an HSA or an ESA. And the reason I'm pointing out those plans is those are the plans that are after tax and grow completely tax-free. So as a general rule of thumb, if you're going to take a small amount of money and make it larger, it's probably better suited for a Roth IRA where you don't pay taxes on the gains. The traditional IRA, since it's pre-tax, you'll still invest it and you won't have to pay taxation annually on the growth, but you do have to pay taxes on the growth when you start taking distribution. So if you're going to take a small traditional IRA and make it larger, realize the entire bucket is taxed when you start taking distribution. So always plan ahead, plan accordingly based on your investment strategy. And I will tell you that anybody nowadays has the opportunity to have a Roth IRA regardless of your income. Okay? They actually prevent people from who make healthy 6-figure incomes from making contributions to Roth IRAs. But based on the rules today, if you have a traditional IRA or you make contributions to a traditional IRA, there's no income limit to do that. And there's no income limit to do what's called a Roth conversion, paying taxes on that traditional IRA to convert it to a Roth. So anybody can have a Roth IRA. Speak to one of my IRA specialists how you can get one started today. But I just wanted to make that note before we get to the actual case studies. You can also self-direct employer plans. We have SEP IRAs, simple IRAs, or even your own solo 401k, or some people like to call it a solo QRP. These are additional plans that can be self-directed, give you tax shelter, but it's specific to people who have self-employment income. So if you're a real estate agent, if you're a mortgage officer, if you're a CPA, an attorney, somebody that just works for yourself, where you're the employer and the employee, you're the boss, you can set up an employer plan that can be self-directed as well as your personal plans, like we mentioned on the previous slide. And then, like I like to say, would you like dessert with that menu? The health savings account and education savings accounts are great tools. They're not technically IRAs, but they are tax sheltered vehicles. And they're for specific purposes. So you can make contributions to what's called a health savings account. If you have the right type of health insurance called an HDHP, high deductible health plan, you could set up a HSA, make contributions to it, invest it just like you invest a Roth IRA or traditional IRA. But the benefit is you could take distributions out of the profit from the health savings accounts investments and pay for qualified out-of-pocket health expenses completely tax-free. So that would be things like the things your insurance doesn't cover, like maybe your co-pays, your prescriptions, your acupuncture, holistic medicines, dental work, eyeglasses, vision, all of those things that you're probably reaching in your back pocket to pay for. Think about how you can consume more goods with tax-free dollars versus the taxable dollars in your back pocket. That's where the health savings account and the education savings account come into play, is that they can be self-directed, but you can take distributions out immediately to pay for qualified expenses that you might be incurring today. The Coverdell Education Account, it works in a similar fashion where you can make contributions, but the Coverdell Education Account is specific to a beneficiary, and that beneficiary is a child, right? A child either could be your children, it can be your grandchildren, it can be your nieces, your nephews. It just has to have a beneficiary that's a child, and it can be invested in the profits within that Coverdell can be taken out tax-free and penalty-free to pay for qualified education expenses from kindergarten all the way through college. So that'd be things like tuition if they're going to private school, uniforms. If they're not going to private school, you can pay for books, computers, iPads, tutoring, all the things that you encounter as a parent or a grandparent to get your children educated. There's a lot of opportunity to pay those expenses with tax-free dollars through the use of a Coverdell Education Savings Account and have you invest that. Now, I want to spend a little time on these plans too, because the contributions to these plans are relatively small. right? With a health savings account, depending on how your insurance is structured, you can contribute either $3,600 a year if it's a single healthcare plan where it's just you that's covered, $3,600. If it's a family plan where your insurance covers you and another person, it's $7,200. The Coverdell Education Savings Account, it's $2,000 per child per year. So if you've got 3 children, that's $6,000, $2,000 in each of them. So again, you can see the contributions are relatively small. So what do you do with these types of plans? What kind of investments work out well? We'll get to that here in a second. But those are the 7 types of plans that can be self-directed: traditional, Roth, SEP, simple, 401k, HSA, and ESA. What are the things you can invest in here at Nuview through those accounts? Well, real estate's obviously one of them. How you buy that real estate could be how you buy any real estate, really. Foreclosures, tax liens, buying apartment buildings, real estate options, which we actually have here today, condominiums, unimproved land, commercial property. And the only real difference in using your IRA to buy these investments is that on any contract, any purchase contract, the purchaser is your IRA. You're still doing the legwork to find the investment. It's just the buyer is going to list your IRA as the buyer, not you as the buyer personally. And then what Nuview does is we sign any contracts, we sign any closing statements, anything that has to do with the investment. We sign as the purchaser, but we do that at your direction, at your pace. So you tell us what we're buying, you tell us when we need to send stuff or where we need to send money. Everything's in the name of your IRA, therefore you get your tax benefits, and then we'll hold the relevant documents associated with that real estate. So if you, per se, buy real estate in your IRA, you do the legwork to find it, draw up the contract showing your IRA is the buyer, we sign it, we send the money to the title company, and then we'll hold here at Nuview the relevant deed to the property showing that your IRA is vested as the owner. So it's really pretty simple, and all you got to do is do it once, and it makes a lot more sense, but I just wanted to cover that real briefly. Other things you can invest in, or that we see people invest in, investing into entities like LLCs, partnerships, joint ventures, and trusts. Now, a lot of times these entities might end up owning real estate. Some people actually like to raise money, private capital, through IRAs to buy apartment buildings or commercial property. They often do that through the use of an LLC or a partnership, and they have investors invest, multiple IRAs into those ventures, and through syndication or whatnot. So that's another common investment that we see through our clients. And we have other clients that also like to do promissory note investments or lending. They like to loan money instead of own property. So no toilets, no tenants, potentially big profits, using your IRA as a bank through the use of creating secured notes secured by property or unsecured notes to borrowers, and have that interest generated from those notes go back to your IRA completely tax deferred or tax free. So let's jump into the meat and potatoes of this class, which is how you take small accounts and make them larger. It often takes creativity and often takes some type of leverage. Okay? So let's just define leverage for a second. Leverage is the simple act of using something to maximize advantage. Okay, and leverage is key when you have a small amount. And there's different types of leverage that can be used. We'll cover these 4, and what I'll do is I'll go over the case studies and we'll look at how each type of leverage is used in this case. Now, a lot of people just think of leverage, they just think money, right? You can use leverage, you can use bank financing, you can use partnership money, you can use all sorts of different types of third-party funding, and that would be using money as leverage. But it doesn't just stop and start with money. Leverage can also be experience. And that's one of the things the self-directed IRA investor can bring to the table, which is experience. So if you're a real estate investor by trade, you have experience investing in real estate, you should be applying that experience to your IRA's investments. I would probably argue if you're investing in stocks, but you understand real estate, are you really making the returns you could be? Or are you not utilizing your life experience or career experience to help grow your retirement account? So self-directed IRAs allow you to use your experience if your experience falls outside of Wall Street. Also, your network. This is real key. Now, with self-directed IRAs and putting you with the keys in your hand where you're driving the retirement account, where do you find investments, right? A lot of times you have to get out there and network. You can go to your local RIAs, or maybe it's just the people within your close, your sphere of influence, it's family members or whatnot. But using your network can help you as a form of leverage to grow your small IRAs or small accounts into larger IRAs. And then depending on the type of account we use, time can be a source of leverage. Now, a lot of time, depending on your age, you've got time to grow your IRA, because if you take out distributions prior to, say, 59 and a half, you might pay a penalty on that. So when I'm talking about time, IRA investments there might be investments that fit better in your IRA than they do personally, right? If it's an investment that takes a little bit of time to produce the profit, well, maybe that's a better investment for your IRA than doing something personally where you're looking to, put food on the table today. So depending on the type of investment, time could be in your favor when you're talking about your IRA's investments. So let's take a look at the first case study. And this is a real simple one. And I've talked about this a little bit on on previous programs, but we're going to talk about real estate purchase with a non-recourse loan. IRAs have the ability to leverage bank financing through what's called a non-recourse loan. Now, what non-recourse means is that since the IRA is the buyer, the IRA is the borrower, the IRA doesn't have credit or income to qualify for traditional bank financing. It has to do what's called an asset-based loan, where the lender is strictly basing the loan off what the IRA is coming via capital. So how much is the IRA willing to put down as a down payment? The banks that issue these loans are not going to be your traditional banks like Chase or Wells Fargo. It's going to be banks like North American Savings Bank, which we actually have a webinar with the president of North American Savings Bank coming up in the next month. So stay tuned for that. But there's institutions out there that have what's called non-recourse IRA loans. And what non-recourse means is that in the event of default, the bank only has recourse to the property. It doesn't have recourse to you because it's not your property personally, and it doesn't have recourse to your IRA's other assets. So those are both good things. So non-recourse just means the bank can take the property and that's it. They can't come after you for any deficiency. And so typically banks that are doing this, they want a larger down payment to alleviate any risk that they're going to lose money on the deal. So usually, again, just generalizing, most of the banks that will do non-recourse loans to IRAs will do it on income producing properties like rental properties, multifamily, commercial. That helps them alleviate the risk per se, as compared to like buying land. You might not find a lot of non-recourse lenders that will loan on land, because if there's no income being generated, then their only safety net is whether the land increases in value or not. So banks that have these loans just want a larger down payment, and typically on income producing property, but the down payment could be anywhere from 30 to 35%. And on. And I will say, depending on the bank, the interest rates are not that bad. So I would say shop out a couple different non-recourse lenders if you're looking to leverage bank financing. But the main point of this is that, yes, IRAs can borrow money. And here's how this would work. And here's how a client actually used it. And I'll show you why it was actually beneficial in this case. So client found a property that was that he could buy for $117,000. Okay, but basically $110,000 and adding some closing costs on there. But he found a property that seemed like a good buy, and he wanted to buy it in his IRA. Now, he only had about $50,000 in his IRA. He didn't have enough to buy the property outright. So he went and shopped out a couple different non-recourse lenders. Okay, he found a local non-recourse lender that he decided to work with. The rate was a little bit higher, but he wanted to work with someone local. Okay, so and really the interest rate isn't that bad when you look at the ability to leverage money and increase your cash on cash return. So this is just the specifics of the loan that he got, which was a loan to the IRA from the bank at 8.15%. It was a 20-year fixed, and the payments were only annual. Okay, so he actually went to his community bank and got this loan because he had a good relationship with the bankers there. They actually offered to give him a loan instead of going to another lender. So it was a little bit different of a structure, but that's how this loan worked. It was annual payments, 8.15%. Now, this enabled him to come to the table with just a down payment from his IRA. Okay, and the down payment after closing costs and everything, total coming at the closing table from his IRA was $36,637. So again, he leveraged bank financing to buy a property that was worth more than what he had in his IRA. He held the property's first 18 months. Okay, sold it for $163,856. Now, I will tell you, if you're new, we've talked about on previous classes that when your IRA borrows money, there is a tax that kicks in to the money that's borrowed. It's called unrelated debt financed income tax. And the only reason I'm bringing this up is A, you should know about it, but it's not a bad thing. Don't get scared about tax when an IRA leverages the investment. So, and don't get confused too, if this client bought this property all cash from the IRA, there's absolutely no tax to the IRA. Only the fact that he borrowed money unrelated to the IRA. Basically, the IRS says, well, we shouldn't allow you to have 100% of the income tax free if you didn't use 100%, if your IRA didn't put 100% of the investment down, it only put a small portion down. So you're only taxed on the debt leveraged portion. Okay. And most of the times that I've seen this actually calculated, the tax is a lot less than you would think, because here's what happens. When you put your IRA in a taxable situation where it's going to have to pay a tax on a portion of the profit, well, guess what kicks in? Now your IRA can use depreciation. Now your IRA can use expenses. It can use the things it normally doesn't use because it's normally not a taxpayer, but once it becomes a taxpayer, because it's leveraging money, outside source money, then you can use those same things that we use as individuals. So the net profit on this investment before paying the UDFI tax, it was $33,190. The UDFI tax that he had to pay was only $3,357. Now, again, I want to remind people, this is not a tax you pay. This is a tax that comes from the IRA. So the IRA actually files, or actually you get a CPA to fill out a form called a 990T. That's 990T. It's the tax form for tax exempt entities. It's the same tax form that is used by churches and nonprofit organizations. But it's when you put a non-tax exempt entity into a taxable situation, you use the form called the 990T. Have your CPA provide it to you. We sign it. But the tax that was paid by the IRA after this is sold, $3,357. So the net profit after the tax on this deal in 18 months was $29,832. When you divide that into the 30 some odd thousand that he put down as a down payment, you can see his net return on investment, cash on cash, was 81.42%. That is great. Who cares if he paid the tax, right? Because other people might say, well, if I've got enough money in the IRA, why don't I just put it all cash and eliminate the tax? Well, you could do that, or maybe you buy 3 houses instead of 1 all cash. Because let's compare it to the same situation if he had not used a non-recourse loan and he eliminated the UDFI tax. What would that work out to be? Well, you would assume the purchase price is exactly the same. The sales price is exactly the same. The net profit is a little bit higher because there's no tax and no loan payments. So the no tax and no loan payments would increase the profit to $43,090. But remember, he would have had to come in with all $117,000 from the IRA. So you divide those two numbers in, and now your net return on investment is 36.82%. Still a good deal, but I would say 80% is better than 36%, wouldn't you? So again, if you use leverage appropriately, if you use it right, it can make wondrous things happen in your IRA. And I will say, if you're going to put your IRA in a taxable situation by paying UBIT or UDFI, use an IRA that's not going to get taxed twice. And what I mean by that is a traditional IRA. If you use a traditional IRA for this investment, remember, you're taxed on the profit as well. You just don't see it until you take distributions. So in my eyes, use a Roth IRA in a situation like that. Use an HSA, use an ESA. Combo accounts together. Combo your Roth IRA with your spouse's Roth IRA. Throw your HSA in there as a buyer too, and throw your ESAs for your kids on there. That way, all the profit that it comes back after paying the UDFI tax is completely tax-free. So I love that case study because it shows you the difference. Again, I'll go back here. Again, 81.42% by using leverage, cash on cash, 36.82% had he not used the leverage. Moving right along. let's look at buying property subject to. So this is a little bit more advanced topic, and a lot of you off-market real estate investors, you might have done a deal like this, where you run into a potential buyer or seller, excuse me, you run into a homeowner that's between a rock and a hard place, right? They've got a property, they live in the property, they've got a loan on the property, and maybe they stopped paying the mortgage. They lost their job. They got laid off due to COVID. They stopped paying the property taxes. Basically, they're between a rock and a hard place. And you, as the real estate investor, want to help solve that problem. But maybe for some reason, you don't want to come in and buy it and get your own financing. Maybe you just want to take over the existing financing on the property. And that's called buying property subject to, which means buying it subject to the underlying financing that's already on the property. This can also be done within an IRA. So here's an actual case study. A client found a homeowner that was in trouble. Okay, I'll just give you the backstory real quick. Property was in a decent area. Okay, property was well maintained. Owner lost his job. Okay, it happens every day, and it happens even more due to what's going on out there with COVID. So this is just an unfortunate thing. And the property didn't have much it didn't have much equity in it. So he was having a hard time selling the property because no real estate investor, beginning real estate investor, I would say, would want to buy it because there's no way to make money on it when it's got no equity. Okay, so a lot of people say, well, I'll buy a short sale. Maybe I'll negotiate with the bank. Has anyone done a short sale? They're not easy. Trying to negotiate with the bank to buy it at a lesser value. But what's the problem with this story? The problem is not the house. The problem's the mortgage, right? The mortgage is 4 months behind, and the bank is wanting their payments. And most banks don't want the house. I'll just be honest with you. I've worked at banks. We don't want the house. We just want the mortgage to be current. So as an investor, this is an opportunity for you to strike up a deal to where if you can come in and get the mortgage current and provide a win-win scenario to the existing homeowner that alleviates the problem of them having continuous reporting to their credit and even worse reporting to their credit if they allow this home to go into foreclosure, you're solving an issue for them. Again, the issue is the mortgage. So in this story, as they're negotiating or talking about this, again, there's no equity in the property, but the investor is really not looking at equity right now. He's more looking at, if I get this house rented, can I make money, right? So in the area, the rents were going for about $1,350, average rents for that size property. The current mortgage payment, which was already 5 years into the loan. So you're already 5 years into the loan on this. And obviously, if you understand amortization schedules, the deeper you get into a loan, the more principal starts to get paid down. So again, being 5 years in, that's a benefit to you if you're taking over that mortgage. But the PITI on this property, again, it's a fixed 30-year mortgage, and the PITI was $950 a month. So if you're just looking at that as a cash flow play, there's some cash flow there, right? So if provided that the seller is willing to work out a solution that prevents further damage to their credit, you can come in and buy the property subject to. And this, again, the buyer on this property could be a Roth IRA, HSA, ESA, or whatnot. So in this specific case, he drew up the purchase contract to show his Roth IRA being the purchaser. Okay. Now, in an agreement like this, since you're going to take over the existing loan, you're really just deeding the property over to the buyer, which in this case is the Roth IRA. Okay. In exchange, that the buyer, the Roth IRA, it pays the mortgage payments and does whatever it does to as far as the agreement goes with that original seller. So in this case, what they agreed is that the owner, the Roth IRA, would pay the past due mortgage payments, and it would leave a couple $1,000s to give to the homeowner to walk from the property. In exchange for deeding the property to the Roth IRA and allowing for the Roth IRA owner to get the property rented, get a property manager in there and start renting it so that you can start paying off that existing note. So the property was immediately rented for $1,350. Once the property is owned by the Roth IRA, the rents come to Nuview Trust Company, and then we just pay the mortgage payments on the underlying mortgage based on the client's instructions. So if you can keep this going, you can see where the magic is. You're taking down a property with only $8,000. You're getting it rented because it's in a good area and you know you can get it rented for more than what the current mortgage is on the property, okay? And you can start paying down that note if you can keep that process going. This also incurs UBIT, I will tell you, because this is a debt leveraged investment. But if you plan this right as a long-term play, you might pay a little bit of UBIT or UDFI on the rental income that comes in, but you can still get away with paying no unrelated business income tax on the capital gains when you sell the property. Okay. So what I mean by that is when you sell property, that's when you kick in any capital gain. But how they calculate unrelated debt finance income tax when it comes to your capital gain is they're only going to go back 12 months of your last 12 months when you sell the property. So let's fast forward in time. And this was his strategy from the beginning. He was going to hold the property in his Roth IRA, have renters pay the Roth IRA pays the bank and pays that down, and holds the property all the way for 15 years, okay, until the note's paid off. Okay. Once the note's paid off, if you own the property another 12 months past that, your average indebtedness for those 12 months is zero. So if you sell the property 12 months after you paid the note off, you still pay zero taxes on the capital gains. So again, great strategy using a small amount of money. There are some cautions with this though, okay? One, make sure you understand the due on sale clause. In most mortgages, what you're gonna have from the original lender is a due on sale clause. Now, what this due on sale clause gives the lender the ability to do is ask for their principal, all the principal and interest due on that loan if the owner sells the property. Now, in my experience, in situations like this, the bank is going to be more happy with just getting the mortgage current. They don't care who's making the payments. As long as the payments are coming in, what's their reason to call this the due on sale clause? Also, if they're looking at the property and there's no equity, they don't want that headache either. The bank just wants the payments to be made. So in this case, but you still want to understand the due on sale clause. So consult with an attorney that understands how to structure subject to deals. I would start there. But in my experience, banks won't call the due on sale clause if there's no equity, but they're getting payments. I've only seen it once, very rare case, where it was a small local lender that actually still was servicing the loan. And it was many years after the investor took the property subject to. It was several years before the actual lender called the due on sale clause. Now, I would expect that the reason they did that is because now there was built-in equity on the property, and they decided, well, technically this original borrower sold the property, so let's call the due on sale clause. But again, it was because there was equity in the property. But since there was equity in the property, here's what the investor did. There was equity in the property and they had already been making the loan payments. So they had history of making the loan, of making the mortgage payments. So what they did is they just refinanced to a non-recourse lender and put the loan in the name of the IRA. Simple fix. But again, still you should understand the due on sale clause. You want to make sure you're prepared for that if the lender comes knocking. The underlying loan, some people say this, well, doesn't a loan to an IRA have to be non-recourse? Yes. So if in this case, you're taking over a loan, and I get this question often, is it considered non-recourse? Yes, it's actually recourse, but who's it recourse to? The original borrower, the owner. So it's considered non-recourse because it's not recourse to you individually, and it's not recourse to your IRA. But you do have to keep that in mind, though, when you structure these deals. That person, that original owner, is expecting you to perform on your promise to them to keep the property rented and prevent it from affecting their credit. So you want to keep that in mind. There's a lot of ethics here that come into play. But most of the time, if you're going to invest and take all this time to do it, you're obviously not going in it with the mere fact that you want to hurt somebody's credit. But always remember, if you're paying the underlying loan, that loan is still tied to that borrower. Make sure you have enough capital in your IRA to cover any unexpected repairs or vacancy. So I would urge you, if you've got, in this gentleman's case, he used $8,000 to catch up the mortgage payments and give the person some money to walk. don't do this deal if you only have $8,000 in your IRA. Make sure you've got a little bit extra in there, or you have the opportunity to make a contribution to the IRA in the event that you go a month without a renter and you've got to, pay the mortgage payment without it being rented, any unforeseen repairs that might have to take place. So make sure you've got a little bit of a buffer or a little bit of a safety net in the IRA, or can make contributions to the IRA in the event that you need to insert some extra capital. I will tell you this, on this specific deal too, remember, the PITI was $950 and the rents were about $1350. Now, as the years go on, what increases faster, rents or PITI? Well, remember, the principal and interest on the loan is fixed. The taxes and insurance might increase slightly, but rents usually exceed that. So as you hold the property, rents might increase year after year after year. So what do you do with that extra cash flow? If you've got some cash, you can leave it in there as an extra buffer, or make additional principal payments on that loan, pay it off faster, right? Get rid of the UBIT and the UDFI by paying off the loan faster with the excess rental income. That's just something to think about. I kind of mentioned this, it's still considered a debt leverage investment, so you will need to factor in any UBIT or UDFI. You're not going to be able to escape the UDFI on the tax or the rental income that's coming in. But remember, you've got expenses too. You've got the loan payment. You could throw expenses and depreciation in this case to whittle down the annual UDFI on the rents, and you can escape completely the UDFI and the capital gain by just holding the property long enough to get the note paid off. Okay, so hope that's helpful. I love those. And I'll tell you this, another story. I have a client that actually owns 5 properties, all taken down subject to with this same strategy. And all he used was a $70,000 IRA. 5 properties bought for $70,000 because he bought all of them subject to the underlying financing. So his plan is in 15 to 20 years, when all those loans are paid off, his Roth IRA is going to own free and clear 5 properties, right? That are all going to be roughly about $300,000 to $400,000 at that point. So great strategy, and definitely think about doing it in a Roth IRA, an HSA, and ESA, or something that grows completely tax-free if you're going to use that type of leverage. Let's talk about another one, real estate option contracts. These are probably not utilized very often because they're a little bit more creative of a deal. It's a little bit more advanced of a thing, but can give you a lot of leverage in buying property that you might not have thought of otherwise. So let's just talk about what a real estate option contract is first. So a real estate option contract is an option contract. It's a one-way contract, giving a buyer first right to buy a specific property in exchange for consideration. The option usually includes a predetermined purchase price and is valid for a specific term, such as 6 months, a year, 2 years, but it has to be a specific price and a specific option period in exchange for consideration. Consideration is cash. Consideration is money that you give to the seller in exchange of having the option to first right to buy that property. It's a tangible investment. Okay? Now, the reason I call it a one-way contract is the buyer does not have to buy the property. Okay, he has options. Okay, he's actually got 4 different options as whether he can buy the property or do something else with it. But the seller is obligated to sell to the buyer within the terms of the contract. So that's why it's one way. The buyer doesn't have to buy the property, but the seller has to sell the property if the buyer agrees to or decides to exercise the option. So the exit strategies with the real estate option for the buyer is that they, one, can either exercise the option within the specific option period. So and I'll give you an example of how this one worked out. Let me tell you the backstory. Backstory was, gentleman lost his job, didn't want to leave the house, okay? Liked being where he was, fell behind on the mortgage payments, okay? Another situation between a rock and a hard place. He doesn't want to sell the property because he doesn't want to leave, okay? He can't qualify for another loan somewhere else, so he doesn't want to leave, but he's having the bank call him, nonstop asking where these mortgage payments are going to be. So a personal friend of his said, well, I'd like to help you out. And I don't necessarily want to buy the property, but I need to have something. If I'm going to give you $10,000, I need to have something to fall back on. So what they decided to do is they decided to draft a real estate option contract. Okay. The option contract had a specific time period of 2 years. Okay. So within that 2 years, the investor or the buyer has to either exercise the option, let the option expire after 2 years, they can assign the option to another investor, or cancel the option. Okay. Now the consideration of $10,000 is non-refundable. So that's your risk being the investor or the buyer here, is that if you decide to let the option expire, okay, you're at risk of losing the $10,000. That is non-refundable. That goes to the buyer. Okay. And the option contract price on this property was $200,000. That was the current value of the property. So basically their agreement is the Roth IRA in this case was going to have an option first right to buy the property in exchange for $10,000 of consideration. The option contract price is locked in for 2 years at $200,000. Okay. And it was specific to 2 years from the date that it's funded. Fast forward in time, 16 months go by. The gentleman, the homeowner who's still in the house, okay, got a job, got a better job than he had before. Now he's making money. He's back on his feet. So he goes back to his financial friend who's got the option and says, I'd like to stay in the house. Okay, what can we talk about to prevent you from exercising the option and buying my property for $200,000? What they did is they said, well, I think it's only fair, since I've got the option to buy it, you want to stay in the house. Let's look at what the current value of the house is. Okay. They looked at it. The house had appreciated in that 2 years from $200,000 to $280,000. So what they decided to do is cancel the option so that the original homeowner can stay in the house. And they decided to split the perceived equity in the property right down the middle. And that's where they came up with the cancellation fee of $40,000. So the Roth IRA in this case put $10,000 of consideration to have a 2-year option to buy this property. The original homeowner decided he wanted to cancel the option and stay in the house. And he did that to meet in the middle and paid a fee to the Roth IRA of $40,000. What else could have happened in this deal? Let's say the gentleman doesn't get his job back. Well, once that option period comes to be, the investor or the Roth IRA could buy the property at $200,000. So obviously you got to come in with money there, maybe use a non-recourse loan, who knows? But you have to do that prior to the option expiring. In some cases, it might just make sense to let the option expire. Let's say the property goes down in value, right? You don't want the house now. Well, you're going to risk losing your $10,000, but sometimes that's the best situation. So you can, as an investor, you can just cancel or let the option expire, or like wholesaling, you can assign the option to another investor, right, for a fee. So assigning the option could have been another option for this client. And in this case, they decided to cancel the option. So it's a real creative way to use leverage. And in this case, the leverage was experience, the leverage was time, the leverage was network, because this was an individual that he knew from a local RIA, that they've become friends. So again, great strategy, taking small amounts of money, turning it larger by understanding a creative solution to a problem that maybe most people wouldn't have thought about. Most people wouldn't have thought about doing a real estate option to a friend that's in trouble that doesn't want to leave their house. But again, maybe this is something that you at least gives you something to think about as you're wheeling and dealing and talking to potential homeowners. Buying property subject to real estate options are a great alternative situation to help solve some problems. And again, all of these strategies, you can see, took very little money out of the IRA. So I hope this was beneficial to you guys. I hope this helped you understand at least some of the strategies on how to make big bucks in small accounts. I'll always remind people that don't overlook the HSAs, the ESAs, even the Roth IRAs. If you're just starting out, these are great accounts that can grow completely tax-free wealth for you and save yourself from paying Uncle Sam too much of your hard-earned money. Well, we will be teaching this class live also in our new upcoming live classes that are starting in September. So if you're in the area of our office here in Longwood, I would highly encourage you guys to come check us out. on September 16th to watch this class live and actually network with some local investors at the same time. You can always stay up to date with Nuview too by following us on Facebook, so you get the live notifications of when we go live for our Wednesday workshops. Follow us on Instagram for some fun posts about self-directed IRAs. Subscribe to our YouTube channel. We want to kind of, we're pumping that up. We're putting more content in there. Literally, we're filming, 3 to 5 videos a week that we're putting on there. So we're very, very active there. And you can always follow us on LinkedIn as well. You can scan that QR code and it'll take you right to our landing pages for those. And like I mentioned earlier, live classes are back. So we'll still continue with the Wednesday workshops for those of you who are outside of the area. But if you're in the area, please check us out. We're going to do these every third Thursday of the month, starting in September. So third Thursday in September is September 16th. We're going to start at 6 p.m. Networking starts at 6 p.m. We'll have food and beverages here, so you don't have to worry about stopping for dinner. We've got your back there. Networking starts at 6. We'll go till 6:30 before we start the class. And it's going to be how to make big bucks in small accounts. And I'll add some twists to it too that I didn't add in here, but it gives you the opportunity to ask questions, gives you the opportunity to network with local investors. And again, a lot of these case studies that I just went over had to do with people networking, people finding investments through, some of the events that they were attending, because you can't come to us and say, hey, Nate, you got anybody that wants to give me a real estate option? Unfortunately, we don't have that type of business here, but we do like to put people in the same room and network with each other. So network with each other coming up September 16th, how to make big bucks in small accounts. There's our address there. Scan that QR code if you want to register for that immediately. And we will broadcast that, by the way. We will be broadcasting it. But again, if you're in the area, you should get a better feel, and it's better engagement when you come live. Also, our promo for the end of the month, as we're about halfway through the month now, we have a promo code. If you use the promo code +1, what that does is it allows you to, if you're going to open one self-directed account for yourself, you can open unlimited after that for you, your spouse, your kids, your brothers, whoever else you want to bring with you, provided you're all doing it around the same time. We will waive the application fee on all those additional accounts. So spread the love at the end of the summer. The love of tax-free wealth. What better gift to give somebody? And what you want to do is just contact my IRA specialist, and their email is IRA specialists with an S at nuviewtrust.com. If you want to take a part of the +1 promo and open unlimited accounts for just one application fee, email them, again, IRA specialist at nuviewtrust.com, and just say, I want my free accounts, and they'll reach back out to you. Make sure you leave your phone number so they can give you a proper consultation and find out what accounts are right for you. So thank you for spending a little bit of time with us today. I have my IRA specialist on the line to answer questions for you guys, and we'll see you next Wednesday for Nuview's Wednesday workshop.